Ladies and gentlemen, good day and welcome to the Puravankara Limited Q4 FY23 earnings conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samar Sarda from Axis Capital. Thank you, and over to you, sir.
Thanks, Nico. Good evening, everyone, and thank you again for taking the time out. Let me start with congratulating the management on a great year of sales and collections, and also wishing them good luck for the next year ahead. As always, the senior management of the company is here with us today, led by Mr. Abhishek Kapoor, the ED and CEO, Vishnu Murthy, Senior VP with Risk and Control, and Neeraj Gautam, Executive Vice President Finance. I'm handing it over to the management for the initial comments.
Thank you, Samar. Good evening, ladies and gentlemen. Welcome to Puravankara Limited's earnings call for the fourth quarter FY23 and fiscal year 2023. I am Neeraj Gautam, the Executive Vice President Finance of Puravankara Limited. Thank you for joining us today. We are delighted to present our financial results for the quarter ending March 31st, 2023 and the full fiscal year 2023. The results, along with a comprehensive presentation, have already been uploaded to the stock exchanges for your review. Today, we will provide insight into our outlook and key initiatives. Before we delve into our financial performance, I would like to highlight the promising prospects of Indian economy and the real estate sector present for the investors. Backed by initiatives of the government and a vigilant central bank, the Indian economy has demonstrated robust growth, controlled inflation, and enhanced current account balances, fostering a stable and favorable economic environment. Simultaneously, the real estate sector in India is experiencing an upward trajectory, fueled by sectors such as expanding internet penetration, e-commerce advancements, increased infrastructure investments, and modernized supply chains. The real estate market is projected to grow at a remarkable compounded annual growth rate of 7 to 8% during 2023 to 2025. The sector's resilience is evident in strengthened developer balance sheet and a surge of equity investment, reflecting a strong investor confidence. Additionally, housing sales have witnessed significant growth across the top cities, showcasing sustained demand and lucrative opportunity for investment. Now, let's dive into our operating performance for FY23, which showcased significant achievements. Our sales reached an all-time high with a total value of INR 3,107 crores, a substantial increase of 29% compared to the previous fiscal year. Moreover, our customer collection from the real estate business experienced a remarkable jump of 57%, totaling INR 2,258 crores in FY23. The average price realization also displayed a strong growth, rising by 14% to INR 7,768 per square foot during the fiscal year. These outstanding results reflect the growing demand for housing and demonstrate our ability to meet the aspirations of end users. For quarter 4 FY23, we achieved the highest ever sales value of INR 1,007 crores, representing a significant 21% increase compared to Q4 FY22 is INR 831 crores. This outstanding performance was supported by a sales volume of 1.21 million square feet, underscoring our strong market presence. Furthermore, our customer collection amounted to 661 crores, reflecting a remarkable 48% year-on-year increase and indicating improved operating efficiency. Our average realization for the quarter was INR 8,321 per square foot. In terms of business development, we are proud to announce that we acquired a 100-acre land parcel in Chennai for product development in FY23. This strategic move strengthens our presence and provides a lucrative opportunity for future growth. Throughout FY23, we successfully launched 9 projects across 3 cities, covering a total area of 6.04 million square feet. Notably, Bangalore and Chennai witnessed a majority of our launch area. Furthermore, we have an impressive launch pipeline to approximately 16 million square feet, ensuring a steady flow of new projects in the coming period. Non-Bangalore projects now account for 44% of the share of ongoing projects and 68% of launch pipeline. In addition to our residential offering, we introduced Gentech Business Park, a commercial project catering to the growing demand of office space. Moreover, construction commenced on the Purva Aerocity, a prominent 2 million square feet commercial project, further extending our portfolio. Comes to the debt management, our net debt increased from 1,846 crore in Q4 FY22 to INR 2,208 crore in Q4 FY2023. The primary cause of this increase was the rise in the number of projects launched and aggressive project execution. However, it is worth noting that our debt per square feet of building space declined from INR 1,248 to INR 1,106 per square feet in Q4 FY23, showcasing our efficient capital utilization. As of March 31st, 2023, the balance receivable from sold units in all launch projects amounted to INR 2,967 crores, which cover about 62% of remaining cost of under construction projects. When combined with value of unsold inventory for all ongoing projects of worth 11,232 crores from the ongoing projects, the company projected to have a total surplus of about 10,118 crores. This projection is favorable when compared to current net debt of INR 2,208 crores. Now, let's move on to our financial performance. In FY23, our revenue from projects increased by 29% to INR 1,236 crores compared to INR 955 crores in FY22. Our EBITDA for FY23 was INR 442 crores with a 31% EBITDA margin, down from the 635 crores FY22. I would like to update that the previous year, our EBITDA was inclusive of a one-time transaction. The PAT for FY23 was INR 63 crores, while it was INR 146 crores in FY22, with a 4% PAT margin. In Q4 FY23, our revenue from projects grew by 32% year-on-year to INR 389 crores. The EBITDA for the Q4 FY23 was 117 crores, up by 90% from Q4 FY22, with a 26% EBITDA margin. The PAT for Q4 FY23 was INR 28 crores compared to a 21 crore loss in a similar quarter previous financial year. I would also like to highlight our dedicated arm for plotted land development, Purva Land. Currently, we have 9 projects across 3 cities, totaling approximately 7 million square feet. These projects are located in Bangalore, Chennai, and Coimbatore. Our recent addition in the launch of Purva Ragan in Chennai in Q1 FY24. With Purva Land, we aim to provide well-planned and flexible plotted land options to meet customers' desire for their dream homes or profitable investments. Lastly, I want to mention our wholly owned subsidiary, Starworth Infrastructure and Construction. They are focused on technology-enabled construction solutions with an order book over 1,600 crores. Starworth undertakes residential, commercial, infrastructure, and industrial projects, providing end-to-end services from design to handover. Operating a fully operational precast factory in Bangalore, they emphasize technology and off-site construction methods. Some of their marquee clients include BMRCL, ITC, Jindal Steel and Power, Taj GVK, BIL, FIRC, Godrej Properties, BAE, and AMPA. I am pleased to inform that ICRA has reaffirmed our credit rating at A1 stable during the year. In conclusion, Puravankara Limited's financial performance for FY23 has been exceptional, with record sales, strong customer collection, and promising growth indicators in the real estate sector. Our strategic acquisitions, successful project launches, and debt management initiatives position us well for future successes. We remain committed to delivering value to our stakeholders while navigating the evolving market dynamics. Thank you for your attention, and now I'll open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Shrishti Tandon from NVS Brokerage. Please go ahead.
Hello. Thank you, sir, for the opportunity. How do you see margins picking up since PAT has been negative?
PAT is a factor of 2 or 3 things. Go ahead. Okay. So basically, PAT is a factor of 2 or 3 key parameters, right?
I understand your question is related to the PAT?
Yeah.
Okay. I thought it was the market. So PAT was negative in the similar quarter previous financial year because the similar quarter previous financial year, our revenue recognition were less and thereby we generated less gross profit and there was a loss for the quarter. However, for last year, for full financial year, we recorded a profit of 146 crore, and this year for the quarter we recorded a profit of 28 crore, as well as a full financial year basis we have recorded a PAT of 63 crore. So this financial year as a whole basis we have recorded a profit, and last year also as a financial year as a whole we recorded a profit. Only for that particular quarter, because of the less revenue recognition, that quarter was resulted in the negative. But that was the Q4 of the last financial year. This Q4 and this financial year we are profitable.
Okay, sir. Sir, can you please tell your plans for commercial along with timelines? How many square feet overall are we planning to launch in FY24 and FY25?
I'll answer that commercial, but I'll just add to the previous question. Basically revenue recognition and PAT is dependent on the quantum of possessions that you hand over in a particular quarter. That is one. And secondly, it's also dependent on what expenses you book in the quarter, which could generate revenue in the future. For example, even if we do a launch in a quarter, there are expenses that we book as costs in the same quarter, but we can't book those revenues. So those are the factors that typically influence the PAT and the revenue recognition numbers. So I just wanted to clarify on the previous point on what constitutes revenue recognition for a particular quarter. And the moment you see higher possessions happening in a particular quarter, you will see more and more revenue recognition and higher PAT. Coming to your commercial question, we currently have about 3 million square foot under construction. We intend to continue to execute these. These will come up for completion in 2025, including about 800,000 square foot, which is called Centex, and about 2.1 million square foot of a project called Aerocity, which is in North Bangalore. And these are both very unique projects in very unique markets, and we're quite optimistic with these developments. And the development is going on at full pace. At this point in time, we're not intending to add any more commercial in terms of new launches for this financial year. But we are out there in the market looking at new opportunities as well.
Okay, sir. Also, it is the news that circle rate for Karnataka will increase. So what is the impact? Will it affect our demand?
No, circle rates don't necessarily impact the demand. See, look, most of all our projects are kind of priced in a way where the circle rate doesn't really have an impact on the stamp duty calculation. The area where circle rate may have certain impact is on cost of approval, wherein certain premiums, etc., that are payable are dependent on the circle rate. But we don't see any significant impact at all on the demand side at all.
Okay, thanks. Thank you. I will join back with you.
Thank you. Before we take the next question, a reminder to all participants, you may press star and 1 to ask a question. I repeat, you may press star and 1 to ask a question. Our next question is from the line of Harish Shah from HS Investment. Please go ahead.
Thanks for the opportunity. So I have a couple of questions. So basically, recently the home interest rates, have increased. So have they led to decline in footfalls or conversion rate? How do you see the current state of high demand market in upper mid income and luxury segment, considering the impact of the hike?
So at this point in time, we have seen no impact on the increased interest rates on any of our demand. I mean, if you look at our last quarter numbers, and I can tell you some ground reality, as of date, we are seeing no impact even today in terms of impact due to interest rate calculations. Last quarter numbers, as Neeraj mentioned, has been our highest number. We've crossed 4 million square foot of sales last year. So we're not seeing any impact on the demand or any footfalls due to interest rate. However, having said that, I think what is very interesting for us and why we see the demand going up is we are entering an appraisal cycle for all the corporates. And even if we assume that it will not be as significant as the last year, which was upwards of 20% and somewhere in the mid-teens, we believe that will obviously give more headroom for a lot of people to make their buying decisions. So that is point number one. Point number two, this work from home concept and the hybrid kind of is really helping in the per person demand of housing. So, when people work from home at least 2 to 3 days a week, they need their own private spaces, which could normally be a working couple with kids. Therefore, we are seeing increased demand on per person basis for residential demand. And the other fact is that rentals have gone up across the board very, very significantly. So if you see, with that kind of increased rentals, the arbitrage opportunity is so low that people would rather buy than to rent. So, across, and of course, you're seeing this happen with the decreased inventory levels in the market. I mean, today we are talking about a little less than 12 months of inventory across India. And Bangalore, in fact, if you look at it, around 8 months of inventory. So, no indicator or no number can show that right now we have any kind of resistance on the demand side.
Okay. Thanks for the detailed answer. And my second question is just linked to what you have just spoken now. So in that context, do we see the pricing, getting on the higher side for your both existing and the upcoming projects?
Look, I think realization is a factor of multiple things. For us, it's also a mix of inventory. Realization is a factor of the kind of product that you're launching and the marketing you're launching in, and the demand-supply dynamics. So currently, the way the demand-supply dynamics is definitely supportive of the pricing, and of course, the kind of projects that we're launching and the value we bring as a brand on the project and in the markets we're present in, we definitely bring a lot of value and therefore command a premium in all of those markets. So I think from pricing point of view, we're quite confident that we will see a positive uptick in the pricing.
Okay, and is it possible to quantify that that would be in low digits or a higher double digit, something like that?
Look, last year we got an appreciation of mid-teens. If I'm not wrong, it was around 14% average increase YOY basis as a number, right? So I think what happens in real estate, and I'll just take a second to explain, is any project that you launch through its project life cycle normally goes through an appreciation of anywhere between 50 and 70%. So as we go along selling our project, and that normally happens because people start seeing visibility of the development and it starts getting closer to the construction completion phase. And of course, as you sell, you have financial closure, and as people see the progress, they are willing to pay a higher price. Of course, subject to the fact that it's a strong brand, good quality, all of those parameters, hygiene, are not counting into this. So we see that trend continuing for us in this financial year as well.
Okay. Last question from my side. How do you see your plotted development projects panning up, especially in Chennai, considering that you have close to more than 3.7 million square feet saleable area? And how do you see the cash flows coming in from this project in this financial year?
So, two parts. Why we are so excited about Chennai. We launched the project last year called South Bay that got 100% sold out in 3 days. In this quarter, as Neeraj mentioned, we have launched a project called Ragam. We've got a very positive response. We've just gone to market as we speak. And within the first 2 days, we have crossed 100 bookings, right? So we are seeing great traction there, and we are confident that with the launches, we've seen and quality of product that we are delivering across the brands. And in fact, plotted people find it very interesting that we have really upped the quality of the brand and command the premium in any market that we go in. So when people are seeing, because we have delivered already a project over there, people are seeing what we are capable of delivering as a plotted development and how it assures them of the value that they get out of the project and appreciation they will get over the life of the development that they do at their home. And we are very, very confident that we'll sell very well. As far as the collection is concerned, typically from the date of launch, within the first year, we typically look at anywhere between 50 to 60% collections of the sold realization. That's the minimum we look at. So supposing we launch in like this, for example, Ragam we have launched now, you would anticipate in next 9 months, because it's 9 months, I would say anywhere between 40 to 50% collections will happen in this financial year. And similarly, depending on when we launch the next project, it will be the same way. I mean, last quarter we launched a project called Oakshire in Bangalore, and it is almost, I think, 80% sold out as we speak. In the first 2 days, we sold about 100 crores of inventory. So again, we are looking at in this financial year itself from Oakshire collecting almost 60 to 70% of the sold value. So that's the kind of traction and that's the kind of turnaround we are able to see as far as cash flows concerned the profit.
Okay. Thank you so much for your detailed answers. If required, I'll be back in the queue.
Thank you.
Thank you. Our next question is from the line of Yashvi Jain from ICI Direct. Please go ahead.
Hello. Thanks for the opportunity. Sir, my first question is about the Chambers project. Since you told me, as you told that you're planning to launch, so when is the date you're planning to launch and what you're expecting the revenue from this project?
Sorry, you're talking about the Chennai plotted development? Is that the one you're talking about?
Yes.
Okay. So there are 2 projects in Chennai. One is a project which we have just launched, which is about 700,000 square foot. In the 700,000 square foot, we are looking at revenues of in excess of 200 crores. There is another project which we will launch within next 2 quarters, which we will launch about 1 million square foot in the first phase. That would be the total revenue potential there will be about another 250 to 275 crores. Of course, there are subsequent phases where we will add because that's a 3 million square foot of development. So subsequent launches will also add value. So that's the kind of numbers we are looking at for this year.
So my next question is, what are the plans for the debt reduction? Since the debt is increasing, so how you are planning to control your debt equity ratio and reduce the debt?
If you refer our slide number 32 in our investor presentation, there we have given a detail of how our debt at the different segment of business has increased or decreased during the last quarter. If you look at the debt which we have taken for a residential business, their debt has come down. It was the beginning of the quarter, the gross debt was 2,195 crore, and the end of the quarter it was 2,122 crore. So we have reduced debt by 72 crore. We had taken debt of 245, taken means outstanding debt of 245 crore for land purchases. That debt also has come down. That is 220 crore at the end of the quarter, so that was down by 25 crore. However, if you look at the debt which we have taken for 2 commercial projects, which is backed by a full-fledged CF line, and there we are developing in commercial projects, then their debt has gone up by 33 crore. And as we progress the construction, that we'll have to draw down, and then construction that will use towards completing the project. And hence debt has gone up during the quarter. Besides this, we have also taken a debt of 115 crore to buy up the cash flow of the JV partner. JV partner sale in a project, 25% of the cash flow we bought out for 115 crore, and that 115 crore, the entire 25% cash flow is now available for the company while we paid back to the landowner. And besides that, I would just like to update you this 115 crore of the loan which was taken during the quarter, which was 55 crore was repaid during the Q1 of FY24. So as we are speaking today, this 115 crore debt also has been reduced by 55 crore. So and hence thereby, which we are trying to communicate is in terms of our debt taken for a residential project and the land is coming down. However, debt taken for a commercial project has gone up because of the condition of creating a capital asset. And we would like to give you further information. If you refer our slide number 33, there we have also worked out, kind of measured the debt with are the area under development. How many area we are, what is the square feet we are under production today with the company, and what is the debt against it. So if you have plotted this number from the Q4 FY19, which was that time the debt per square feet about 2,077 rupees per square feet. Today, as we are speaking today, the debt per square feet for development is 1,106 crore. So it's substantially down and it's a decreasing trend. Immediate previous quarter, it was 1,291 crore. And hence it's reflecting, though the debt in absolute number has not come down substantially. However, while we added the 9 projects during the financial year, and thereby these all 9 projects have gone for production as well, and hence per square feet debt which is utilizing today has come down.
Thank you, sir. So my next question, are we planning any new projects for in future, especially for pipeline sector?
Yes, of course. Total, we are looking at launching 16 million square foot of developable area and a sellable area of 13.7 million square foot. This is on slide number 21 of the ICT. Of this, about 3.74 million square foot sellable areas in Puravankara, 6.22 in Provident, and 3.73 million square foot in Purvalai. And this is spread across the south and west of India.
Okay, sir. Thank you so much.
Thank you. Our next question is from the line of Thirat Muchala from Ilus Vidya Advisory. Please go ahead.
Hi, thanks for taking my question. Just coming to the cash flow statement, I wanted to understand that there is a significant increase in operating outflows for the year. So is it because of accelerated construction, or is it because of some other reason?
So if you look at our operating, I would like to give you the comparison between operating inflow and outflow both. Our operating inflow has also increased during the quarter and during the financial year. At the same time, operating outflow also reflects. So what operating outflow has gone towards number 8 for fastening the construction, and with the more construction progress we achieve, the collection, it's resulted into more collection. That's point number 1. Point number 2, we have launched 9 projects during the financial year, and hence to launching these 9 projects, we have initial working capital which is required to launch expenses, approval expenses, etc. And that outflow also gone towards launching these projects. Outflow or the collection of these projects will come in the coming quarters. Besides that, we have also spent about 125 crore on this 2 commercial projects which we have mentioned, the Gentech and AeroCity. That is also included in our outflows, and hence the outflow has 3 characteristics. One is outflow related to the ongoing under construction project, against which we have collected 2,680 crore. Outflow, which is for new launches, which is the initial working capital. The inflow for this investment will come in the coming quarters. And third, the outflow for the commercial development. By spending this money, we are developing a capital asset, and this outflow is fully backed by the CF line. Hope this clarifies your question related to increase in outflow versus our inflow.
Yes. And coming to two particular matters, one is 12 months ago we announced that we are aiming at 12 million square feet of launches for FY23, and we have done 6 million. And I think this, and now you guys are speaking of, I'm mistaken, but is it 16 million that you're targeting for the next 12 months?
16 million of developable area and about 14 million square foot of sellable area.
Right. So we've had a history of not meeting these targets. If you look at all our presentations in the last 5 years, so how confident are you at meeting these targets?
Look, I think what's positive, and I'll always look at the optimistic side first. And I personally believe that we are in the right direction. We are working on actually the entire portfolio. Fortunately, unfortunately, in real estate sector, it takes time, and the timing can't be fully in your control because of the external environment we deal with. Having said that, if you look at the new launch pipeline, it consists of the previous year's pipeline, which is of that 6 million square foot that we missed. But having said that, we missed by a quarter or two. So what is happening is that there may be deferment, the value is not lost. In fact, value has really gone up because the prices have gone up, fortunately for us. And hence, in fact, we have gained value. But having said that, our focus is really to launch it as quickly as possible. All of this 14 million square foot today, what we are talking about, is in advanced stages of approval. So we are quite confident that this year we will get, we should meet the target, or maybe we will get definitely very close to the target, if not cross it. So yeah, I mean, what I can say for sure is that we're working on the entire portfolio, and unfortunately the nature of the business, everything from the local environment to elections to everything impacts us. But having said that, I think we are very much on track as far as our new launches are concerned.
Okay, I wish the best to the team. Can I squeeze in one more question?
Yes, please.
So just for deliveries, I think we are missing a slide in this particular presentation. For FY23, how much have we completed or delivered to customer?
Give us a moment, we'll confirm that number.
Sure. And for FY24, what's the delivery number in mind that we should be able to hand over?
So we have delivered in excess of 1,600 units in the last financial year. And for the next financial year, our target is to double it and deliver in excess of 3,000 units. Total area that we have delivered in last year is 1.73 million square foot. And next year, we are talking about delivering in excess of 3,000 units. So obviously, almost doubling the number.
So does that imply that revenue recognition might be almost double in the next year?
That implication is for you to understand. But yeah, I mean, what I'm suggesting is that's the kind of delivery that we are working with.
Yeah, the revenue recognition is a function of delivery, and hence your understanding is correct.
Wonderful. Thank you, sir, and all the best.
Thank you.
Thank you. Our next question is from the line of Sukhim Mafte from Amin Securities. Please go ahead.
Hello, sir.
Yes.
Sir, my question is on the land bank front. Are we looking to do any acquisition?
Of course, we are looking actively pursuing transactions across South and West. We have a robust pipeline of acquisition, and we are moving forward. But the process it's quite painstaking because the funnel can be as large as you want, but it takes time to conclude. But yes, we are actively out there looking at new acquisitions for Puravankara, Provident, and Purva land, with a special focus on the western region, especially in Mumbai and Pune.
Okay, sir. Sir, my next question is, how much is the ready-to-move-in inventory left for your projects recently?
As of now, we have only recently. There's nothing ready to move in for launch recently. Total ready to move in inventory is down to 0.26 million or 260,000 square foot approximately. That's pretty much insignificant because most of this inventory is in some of the newer projects which we have just about completed, and we're looking at selling and handing over.
Okay, sir. Sir, anything new on the ESG front?
Yes, definitely. So we are completely focused on ensuring that we are not only ESG compliant, but we are going to be ahead of the curve in next 2 to 3 year time frame. So there is a lot of work going on in this space, all for environment, social, and governance on all pieces. We should publish our ESG report in the coming quarter for the previous financial year.
Okay, sir. Sir, my last question is, what is the launch date for your Goregaon project? What's the category and ticket size?
So for the Goregaon project, that's a Provident project. We are looking at a ticket size of about 1 crore per square foot. At this point in time, we are looking at it currently in this financial year for sure to take it to market.
Okay, sir. Thank you, sir. All the best for your coming quarters.
Thank you. Our next question is from the line of Srishti Tandon from NVS Brokerage. Please go ahead.
Okay. Thank you, sir. Any redevelopment in pipeline? Like there is a lot of competition. So how are you planning to expand in MMR?
So we have currently 2 projects ongoing. Our MMR strategy is really focused, as I mentioned earlier, in redevelopment as well as JDA and brownfield projects. We understand the market very, very well. The leadership team that has been put in place there and the leadership in Bangalore is very familiar with the landscape in the western markets. In fact, Puravankara comes with an advantage in the western region because we come with the strength of our fast delivery of over 45 million square foot in the rest of southern markets, and the fact that we bring a high quality of development, and we have demonstrated it in some of our projects on how we display it, and the kind of traction we are seeing. We are very, very confident that we'll be able to be extremely competitive in the marketplace. Our footprint, of course, in MMR will range right from South Bombay going up to the MMR region, wherein we are looking at projects to acquire and do under Provident brand, and of course, few plotted developments. So we will have a fairly spread out footprint over next 2 to 3 years time frame in MMR.
Okay, sir. So what is the closing time from start to the launching of project?
From the date we deploy capital to launch, typically depends on the market, but generally will be anywhere between 9 to 12 months outer limit. But our attempt obviously is to do it shorter than 9 months, but between 9 to 12 months outer limit.
Okay, sir. Thank you. One last question. Can you please share your growth plans, profit visibility?
We don't give any forward-looking statements, but as you mentioned earlier, we're looking at adding another 14 million square foot of new launches, and I think you should refer to our slide which is 2 slides. One is the slide number 29, which kind of gives you the total cash flow potential, and also the slide wherein which is slide 34, which talks about what is the total surplus from projects which are in the launch pipeline. So if you look at that slide, surplus from ongoing projects, we are looking at about 6,550 crores. From the projects which are in the launch pipeline in 24, we are looking at 3,568 crores. That leads up to about 10,000 plus crores at the current prices. And then if you look at the gross debt that we are sitting on is about 2,600 and cash equivalent net of 2,200 crores. So that should kind of give you a sense of what kind of surpluses, and then eventually all of this lands up in your P&L and the balance sheet.
Okay, sir. Can you give any guidance in terms of CAGR and profitability in next for 2 to 5 years, upcoming 2 to 5 years?
So, I mean, I leave the caveat to you to calculate given what information I've already shared with you. But what I can say is that our EBITDA numbers are stable between 26% to 35%, depending on the asset class we're looking at. Provident typically is between 26-28%, Puravankara around 30%, hovers around there, and the Purva land is in excess of 35%. So that's the kind of EBITDA margin we are talking about, and with the volumes, I leave that math to you. Thank you.
Okay. Thank you so much, sir, and all the best for the upcoming quarters.
Thank you so much.
Thank you. Our next question is from the line of Chandra Bhanu from Individual Investor. Please go ahead. Mr. Chandra Bhanu, your line has been unmuted. Please go ahead.
Okay. Thank you, sir. Thanks for the opportunity. This year, on consolidated basis, we got a net profit of 67 crores. But I could not see in the results that company has announced any dividend for the shareholders. That is one question I have. And then the second question is it a pattern for Puravankara that compared to the fourth quarter, the first quarter delivers better PAT? Is it anything regular pattern?
Not really. Our goal is really actually honestly to stabilize this in terms of quarter-on-quarter launches and quarter-on-quarter delivery. However, that journey, I mean, because of the change in accounting standards, etc., that journey takes its own course to deliver because our product delivery cycles are fairly long. So our goal is to try and stabilize that on quarter-on-quarter basis as we go forward, but that result we will see over time. And as far as, what is the second question on the dividend? On the dividend, we have not taken any decision at this point in time. I think we will wait for the opportune time and revert to you on that.
Okay. Thank you.
Thank you. Our next question is from the line of Mr. Samar Sarda from Axis Capital Limited. Please go ahead, sir. Mr. Samar, your line has been unmuted. You can go ahead with your question.
Yeah. Hi. Abhishek, I thought I'll take a couple of questions this time. On the cash flows, you did explain like the outflows do include capex also. I might have missed that. If you could confirm how much of this 20 to 80 crores is capital outflows and establishment expenses?
So how much is capital outflows and establishment? So I would think, I think we acquired land worth about 200 crores in last year, if I'm not wrong.
That's
About 120 crores is about capex, which for the project we have done, and our
124 crores.
And operating into about 90 odd crores are GMA and marketing costs about marketing.
So capital investment basically is 124 crores.
124 crores, and the establishment cost which we have, about 90 crores is establishment cost.
Residential construction cost, like cost towards residential construction, would be around about 1,650-1,700 crores?
Yes.
Okay. How much is the jump like from FY22 on this number?
Samar, what we'll do is we'll send these details comparison between. I understand your question. You want to understand the split of our cash flows, which is for the residential, which is for establishment, and comparative numbers. We'll work out the numbers and send you offline.
Fair. The second question was the 4,200 odd crores of surplus from area which is already launched. Like, what is the timeline for other than like what is left for sale? How much of these cash flows will come in over the next 2 years to Puravankara?
So, the way we look at it is all this cash flow visibility which we are talking about, which is the full of 6,550 crores, 4,229 is definitely within next 3 years time frame, and the 6,550 you would look at anywhere between 4 to 5 years outer limit.
If you look at our run rate from our residential business itself, we collected 2,248 crores from last financial year. If I maintain that rate, that will definitely grow by the new launches and the project towards completion. But even at that rate, also we can collect in 2 years. 4,000 crores, 5,000 crores definitely will going to collect.
Yeah, 5,000 we will definitely collect in next 2 years. But he's talking about the surplus. So the surplus, I would think, in total, including the new launches, which is going to be coming up, all of that surplus we can take the number as maximum 5 years, 4 to 5 years from now. Because I'm assuming this year when we are launching, maximum 4 years, 48 months for all the completion of all the projects. Some may be earlier because, as I mentioned earlier, almost 4 million square foot is plotted development, and that should come around within a short span of time. That capital will come back within anywhere between 18 to 24 months outer limit. So I think we should break that down into these 3 parts, and you will see that the cash flows will continue to remain strong.
Okay. The next question was on the inventory months. Like most of us have become quite scientific with respect to tracking this number, and like so are you as a company. So we have the 16 million square feet which we have released for sale, of which we've sold 8 million square feet. The current run rate is 4. God willing, it will go up. But even at 4, we have 2 years of inventory, and we are planning to launch another 16 million square feet or release 16 million square feet for sale this year. So, like, what is the inventory months as a company we are comfortable with? Because, like, most of your peers are less than 12. Of course, some of your peers are between 30 and 35 also. For us, like, what is a comfortable number?
So I'll tell you how we manage our inventory. A project, when we say we are taking it to market, doesn't necessarily mean that we open the entire inventory for sale, right? We open inventory basis the quantum of volumes we are selling at launch and in a particular year. Our optimal number to add any new inventory in a particular project, which is a subsequent phase, is 70% of sales having done in the previous phase. So if you look at it at any point in time, our inventory which is available in the market is in a manner which is very, very comfortable for a financial closure of the project, and then of course you're looking at the surpluses. So we manage our inventory in a manner at any point in time never to overcommit on the construction cost for the project. So when we launch, typically within the first year of the launch, if you would see most of our numbers, our sales will be anywhere between 40 to 50% of the inventory open for sale. In the next year, typically it will go to almost 70% somewhere in the middle of the year, and then we'll open another phase of that project, and so on and so forth. So that guideline principle controls our commitment as far as the construction cost is concerned. And then, you're right, last year we moved 4 million square foot, but 4 million at that rate will take 2 years to go, and then another 16 million we are adding, but 16 million not opening for sale at one go. Let's assume we'll open another 6 million square foot. I'm not giving you the right number right now, I'm giving you an assumption. Please don't take it as my indicated number. The number reality will be very different. But I'm saying, even if I open 6 million square foot and I sell 3 million square foot this year, plus the 4 million of last year, it goes to almost 7 million square foot. But what has happened is that my overall sales numbers have gone up. At any point in time, I have never overcommitted to the quantum of construction I'm committing myself. So that's how we operate. That's the principle with which we operate.
But the 16.5, excluding the convert commercial or even the convert commercial, which is the case, that's already released for sale, right?
Sorry, 16.5?
On slide number 38, the 16.5 million square feet across the 30 projects, that's the entire area which is released for sale.
I'll explain to you, Samar. Out of 16.53, which is released for sale, 52% has already been sold. Today, inventory which is open for sale available is only 8.53 million square feet. The second last column on the slide, 38. So 8.53 million square feet, which is inventory, which is right now open and available for sale today. Besides that, we have about 7.12 million square feet, which is which is third column from the left, okay, which is with 7.12, which are inventory, which from the existing project which we have not opened for sale. So out of today, which are the project which is under production today, 8.53 million square feet, which is available in the market for sale, and 7.12 million square feet, though we have all the approvals in place, but we have not committed any construction cost, we have not started the construction, we have not opened for sale. Based on the requirement and how market performs, we'll keep opening the towers out of the existing project.
Okay. And my last question was on the cost of debt, like from a balance sheet perspective, and like even just like how liquid the promoters are. Like your absolute debt is comfortable, but if you compare the cost of borrowing for Puravankara versus some of the peers, it's probably 250 to 300 basis points higher. So why is that so? And are we working to probably bring it down and closer to some of like the larger peers of Bangalore or Bombay?
Number one, we are working to bring it down. The point number one. Point number two, if you look at last 1.5 years, interest rate has gone up, and if I look at the banking and financial institutions, they have increased the repo rate. RBI itself has increased the repo rate by 250 basis points. However, if my interest rate is concerned, of course, where we are comparing to the market, it is a little higher side. But if I compare to my own performance, it was at 10.569% at the beginning of the year, today 11.31. So though interest rate has gone up by 250 basis points, our interest has not gone up. However, as the right feedback you've given, that we are continuously working on reducing this debt. Part interest rate cost is also a little higher because part of my debt is against the land loan, and part of debt is for the construction of commercial projects. And the comparison which you are making from some of the companies of the Bangalore, which has substantial part of debt against the LRD, and hence the interest rate is LRD interest rates are lesser compared to the construction debt or the debt for buying the land.
Fair enough, Neeraj. I'll probably hand it over to you guys again for final comments.
Thank you, ladies and gentlemen, for joining us for our Q4 and annual conference call. And I'm wishing you a happy weekend to all of you. I hope that me and my colleague has answered all your questions correctly. And after that, we are also available for further questions and any clarification. Kindly reach out to us. We'll provide you the suitable response. Thank you very much.
Thank you. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.